Hi all, John Deerley, Head of Revenue Management Education here, and today we're going to be talking about Park City, Utah market data. This is part of our deep dive series where we jump into some market data and take a look at what's going on in the market at this time, what are some trends that we're seeing, how that relates to what's going on at kind of a national level or in other regions, and talk a little bit about strategy about how to move forward into the upcoming quarter and upcoming year. Before we get started, I'm going to be using a lot of Wheelhouse data in this conversation. I do have some other data pulled up from other places, but keep in mind that this data is available to people, whether or not you're a Wheelhouse customer in many cases. I'm going to pull up the market reports, which you can access just by signing up with Wheelhouse. And I'll also refer to things like PACE quite often. And if you don't have a good way to see PACE in your portfolio, Wheelhouse actually offers free performance insights, which includes pacing data all the way to the daily level for free. So if you want some more information, or you like the data you're seeing here and want to access it, go to usewheelhouse.com and sign up, and feel free to reach out to us for more information. All right, let's go jump into some data. Okay, so I have the market report pulled up for Park City, Utah right here. And if you haven't been to a Wheelhouse market report before, it's a good tool to get a really good high level kind of understanding of what is going on. It's going to give us the entirety of the region. We do have other tools to get into smaller parts of the region, but it's a great way to kind of see what's going on. And before we kind of jump in to what's going on this year, I do want to give some comparisons a little bit year over year. So I'm going to hop over here to the occupancy page, and we're just going to take a look at 2024 and 2025 briefly. So looking at 2024 and 2025, 2025 was kind of a tough year for a lot of people in the industry. In Park City, the occupancy started out pretty good, but a little interruption with the snow patrol strike. So we do see a little bit of kind of lower occupancy performance, a little bit of attrition across that Q1 high season. Now, when we compare that to kind of what happened nationally, Q1 actually generally started out pretty decent for most markets around the country. It looked like things were going to be at least stable year over year, especially if we go back to 2024, kind of the end of the year, we looked at early booking looked really strong. Once we get into about spring, we start to see some dragging. Part of that maybe because of Easter, but maybe some other reasons as well. And really from starting in the spring, pretty much most markets around the country start seeing shortfalls start to appear pretty consistently. And that kind of occurs all the way through the rest of the year. That seems to be the case here in Park City as well. We see that we already were having some shortfalls going on, but in spring we see those shortfalls start to kind of lengthen, especially in the summer, and really just persist across the year. There's another kind of national trend. In September, we saw another big slowdown. Some markets had started to recover a little bit in the summer, recover their occupancies. And we see that in September, that really switches again, and we start to see pretty significant shortfalls through the rest of the year. Now, it hasn't helped here that in Park City, we would, obviously these kind of early pre-holiday periods are going to be pretty weak, but we also haven't been helped by having very much snow. I do have pulled up a few things as we go into this year about what's going on in Park City. Obviously, you guys are there and but a few things that really stick out to me is that, not a ton of runs and lifts are open yet, still as we get towards mid-January, unfortunately. And weather forecasts it's cold today, which is nice, but weather forecasts continue to keep putting weather above freezing, which is really causing an issue for getting these ski runs open, really causing a problem because, not only is the short-term booking going to be weaker because there's maybe not great snow out there, but it's also affecting people who are planning ahead. I'm sure that you have lots of people who are planning and they're kind of guessing, but, if they're going to guess, like, when is this going to be good skiing, they're going to start booking a little further out, and it really makes this, like, kind of through the rest of January a really risky time period to try to, get bookings on the books. In addition to that, I also pulled up another article that I thought was pretty useful. This is going to be trailing a little bit. We know this is the last year for Sundance. And we're coming off of a year that has been pretty tough, right? So this article came out pretty much this week, which is pretty good. And it's looking back at what the city has reported. I always think that these reports are really interesting because they do kind of confirm trends that we've seen everywhere. And what they're talking about is lodging taxes, right? Lodging taxes are down. Now, as we get into this kind of period, we can see that like lodging taxes in October were down pretty substantially. Remember how I mentioned that kind of across the country, we saw a massive slowdown in September and really, really big shortfalls through the rest of the year in Q4, kind of across American markets. That seems to be proved out here in Park City as well. We see a pretty large 30% down in lodging tax revenue for the city. These are just straight taxes. So if you're talking to your neighbors and competitors and they're like, no, we did pretty good, they're either lucky or lying, because the city is reporting that they had a pretty significant decrease year over year. And in fact, we're also quite short on the budget side. Now, it is interesting to me that they're not down quite as much in the budget. So they were expecting some down growth here overall. Now, in addition to that, quarterly, you can also see that this is still down, not down quite as much, but that kind of goes into that national trend I was saying, which is the fall really started to fall off. But the quarter prior to October, I don't know how they're kind of doing this quarter, August to October, down about 10% in revenue, under budget 8%. And then that 10% is really a year-to-date thing. So overall lodging revenue across the city has been down, right? Now, this is lodging revenue, so this is all, includes hotels, includes short-term rentals, all that kind of stuff. They do mention that sales tax collections are a little higher, but not that much, only 0.5% and a little bit over budget. Now, if you read this article, it is kind of interesting. I think the city commenters are not very clued in, because they say some things that don't match the data at all. They said that like nothing is really weak. Well, that's to be unknown. There's been a lot of weakness across a lot of American markets this year or last year. And so there may be some more systemic things. So maybe they're being a little hopeful. They also mention that this is interesting. We're definitely not seeing any sustained slowdown in visitor spending. This just isn't true, right? Because it may be partially true, right? Because there may be less properties. They don't report on that. And if there are less properties, that is maybe how you can get occupancy down and average daily rates down, or average daily rates and occupancy being the same, while still having like a significant shortfall in tax receipts. But so either I think they're kind of like being really hopeful here, or actually we're seeing a lot of properties exit the space, which is not really a great... It's still not that to me is an indicator of a sustained slowdown, because if enough properties left the space where occupancy and ADR are consistent, but revenue is down 10%, that means demand is just down straight up, right? Because we're maintaining the same level of occupancy with less properties. So a little bit confusing there. I think that it is something maybe we should be worrying about, especially as we kind of get this last Sundance coming in. Unfortunately, not some great news from this kind of like article, but it is a really good article when you're talking to your owners, because your owners are probably wondering what's going on. And they're probably, as working with owners, they have a limited view. They're either talking to their friend who's telling them whatever they want, or they're hearing from salespeople in your competitors who are telling them whatever they want to hear. And this is a nice piece of data, because it really does give them a clear picture. I mean, you cannot argue with the fact that year-to-date value is down 10% for lodging tax collections and was down 30% in October. Obviously, we're a few months past October. We should start to see this data. It probably trails a couple quarters in terms of how it's reported, but we should start to see an update. So let's hop back over to this market report and take a look at what's going on in 2026, right? We have a little bit of background. We're coming into this year with a few tough kind of situations. I'm going to pull off the 2024 and we're going to put on the 2026 and kind of see where we compare 2025 and 2026, right? We don't have a ton of ski markets or ski runs open yet. The weather hasn't really been great in that it keeps warming up a little bit. So what does this mean for kind of where we are this year? Now, being a ski market, I'm looking at the entirety of the market, not just large homes or small homes or anything. We're looking at everything, and we're looking at everyone from host to professionals. So we really have no filters here. We're looking at the entire performance. We're looking at all the bedrooms, all the stuff, right? And so like we might expect in a lot of ski markets, you have a lot of stuff that books early, but you also have a lot of stuff that books last minute. And it does look like we have some pretty reasonable amounts of occupancy on the books, even though we're already in January, right? So we have, basically we've got, almost half of what was booked last year for January. We've got maybe about a quarter on the books, a little bit more actually for February. And then we've got about a fifth on the books for March of what we finished with last year. I went ahead and pulled the pacing data for you guys so we can kind of see this. January is actually, as you might expect, is down a little bit. We don't have that kind of last minute demand that's really getting pushed by good weather, but it's not down a ton. It's down about a gross 3 to 4%. So not terrible, but it does mean that like we're already a week into January. You have to be pretty competitive. You have to probably try to drive occupancy because there's going to be other people who are in this situation. And, we're getting to that point where it's kind of unknown how much you're going to wait for conditions to get better. This is not a problem. I would suggest if you have friends in other ski markets, you talk to them about what they're thinking, what their risk tolerance is as well, not just what's going on in Park City, because we've seen a lot of these kind of snow situations be pretty difficult across a lot of Western ski markets this year. Interestingly enough, if you got friends in Tahoe, I would talk to them. They've recently gotten very, very good snow after having a pretty poor early season. And it will be really interesting to see how responsive people have been in the short term. If they've seen a lot of bookings without having to give up a lot of ADR, maybe that means you can be a little bit more confident holding. If they've seen that like maybe the consumer is still really struggling to like purchase in the last minute, even when the snow gets good, it may mean you need to be a little bit more conservative now. As we move over to February, the February situation is actually looking pretty good. Okay, so we have a situation where there's pretty decent occupancy on the books, about a quarter. Like I mentioned before, early booking has been really strong. If you listen to our revenue management roundtables last year, in the fall, we had a few ski folks coming and they were saying, hey, early booking is still looking good. People are planning ahead, especially in those bigger homes. And a lot of those people were looking to hold rate. And we're actually, this is where the story flips. We're pacing a little ahead where we were last year for February. Now, the interesting thing is February fell a little short year over year. So we may not be pacing on track for the 2024 season, but we're definitely pacing on track to at least try to maintain a little bit in 2025, right? So that's a good sign. We're seeing that occupancy come on the books. It's still booking a little early. And what I would encourage you to do is it's probably people are booking out here now because it's a little bit more of a sure thing that the weather is going to be better and the skiing is going to be good and the runs are going to be open. So I would really, really focus here on taking advantage of this. Make sure you are selling for February. Maybe be slightly conservative in case, we can't predict what's going to happen in the world, the economy, or the weather. But this seems like a big opportunity to really stay ahead, especially if you're trying to maintain this year. And then for March, again, we have quite a bit on the books, and this is also another good story. When I pulled up the pacing data, we're also about 4 or 5% up in March right now. So again, another big opportunity. People are probably planning out there because it's more of a sure thing, especially knowing that the weather hasn't been great in the short term. So people are like, hey, if I'm going to get this in, I'm going to book for this. I'm going to make sure to go in a time when it's going to be good. And this is really your opportunity to do what you can here and get your bookings to kind of stabilize the year. I would say that the most important time periods you can spend for your revenue management right now are February and March. And then instead of just spending all your time thinking about January, maybe you just be a little conservative and try to drive the occupancy, and the last minute demand will come in how it's going to come in. But hopefully, if you're doing a good job here, you'll be able to get that pacing on the books, probably ideally a little bit higher than you may have had last year. You want to pace ahead, and you'll do so ideally at a good ADR so that you don't have to compete if things get a little volatile later in Q1. Now, looking forward into the rest of the year, it is pretty interesting to me. We do see occupancy across the mud season, the slow season, and we do see occupancy already coming on the books for summer. So this goes into this trend, which we keep kind of seeing. We saw all through last year. We kind of saw starting halfway through the prior year in 2024, which is advanced booking is really still good. People who are planning ahead have the money to travel, are planning for it, and that is probably one of your most valuable windows right now. What that means is it is absolutely critical to make sure your rates are reasonable for what you're forecasting you're going to make. It's very common in our space for the market to be overpriced. We'll take a look at this in a second. It's very common for people to put prices well above what they actualize at. And that means you're just missing out on this early booking window. You might get a couple like really high rates, but if people are looking, you really want to capture more market share. And the way to do that is put your rates in a reasonable spot. An easy kind of rule of thumb, I would say, is just look at your average ADRs for that you actualized in 2024 and 2025 for these months, and make sure your rates within at least 10% of that, maybe 15%, and don't try to push too hard. And that way you can really take advantage of this early occupancy that's going to come on the books and hope ideally stabilize your position as we get into those months, because the short-term window seems to be really unstable. I think based on trends last year, our shoulder seasons and our low seasons are going to be pretty competitive again. I think that people will still travel for the high season generally, but they're not going to be making all those extra trips, and rates are going to be pretty low, competition pretty fierce in the short term if you wait till the end to get reservations for these time periods. The next thing I want to pull up is asking rates. So we were just looking at occupancy, and occupancy in my mind is a great way to see kind of like how demand is coming in. But asking rate is a good way to see how the market itself is pricing. And to kind of go back to what I said about like you kind of want to get that early booking on, you maybe need to be a little bit more conservative, but the markets tend to price a little high. We see that trend here. So this is the average rates that are being advertised, whether or not something is sold or has been sold or is available, right? And something we see here is pretty consistently, people are pushing rate across the board, right? Rates in 2026 are higher than rates in 2025 in terms of what's being advertised, despite the fact that in January, we're maybe pacing a little behind, not a lot. It's maybe a good thing in February and March, but you know, you need to decide if you are actually capturing that rate, right? Like, you know, the market is pricing higher. That gives you opportunity to kind of push forward. And then out here, as we get into these kind of shoulder and low seasons, the rates are pretty consistently high, right? They're higher than they are year over year. In my mind, that speaks to an opportunity. Contrast this, I want to show you ADR. And so we mentioned that pacing other than January looks pretty good. There's a pretty big mismatch here. The way the market is advertising, prices are higher, but what's actually coming in on the books is a little bit different story. The occupancy on the books for January is actually down year over year. So those people who are booking are being more conservative. That early pacing in February, I mentioned before that February and March are pacing a little ahead. We get a little bit of mixed story here, but the pacing ahead in February is actually occurring at a little lower ADR than last year. So the people who are getting booked are not those people who are setting their rate higher. They're those people who are being a little bit more conservative. Now that story changes a little bit as we get into March. That's kind of interesting. It could partially be the week going into Easter. It could be that it's a little bit further out so that we're seeing both good pacing and high rates, but it does mean that there's a little bit of opportunity here. But this I think is really interesting because when we looked at asking rates, we see, oh, hey, rates are way higher. Hey, if I'm looking at my comps, everyone's got a higher rate. I should set a higher rate. You know, especially if we know that February and March are pacing ahead and we have good pacing for the summer. When we actually look at ADRs, though, we see year over year that these are down a little bit, right? So the people who actually are booking are being more conservative. They're taking market share by putting their price in a reasonable place, and it really supports what I was saying before. And I think it's really, really key to understand that, because if you're just looking at your competitors and you're just thinking, hey, I need to raise the rates, it's going to look right to have high rates, especially if you're then looking at market occupancies and saying like, hey, other than January right now, pacing looks pretty good, so I should have my rates high. You may be missing out on the market share that's really going to stabilize your seasons, especially as we get further in the year, because you're priced too high. Now, the last thing I want to kind of look at here to drill that down, this is us looking at the entirety of the market. If I look at asking rates again and switch this to just the high performers, again, you see a little bit different trend. Instead of the rates being higher, you see that the highest performers are undercutting a little bit in January where we're pacing behind. They're actually undercutting a little bit in February too, where we're pacing ahead at a market level in occupancy, and they're starting to edge down a little bit in March. So you can see that not only is the occupancy that's on the books a little lower or on par with last year, but the highest performers in the market right now are also underpriced, like pricing under the market. So you see a trend where the market's overpriced, the people who are making the bookings are being a little bit more conservative, and they're using that to get market share. That breaks down a little bit out here. You still see that further out, the highest performers are still a little higher priced out here, but it doesn't seem to be nowhere near as large as when we look at the market as a whole, and we have pretty significant price increases out here. Okay, this last little thing I want to touch on for you guys is just taking a little bit of a look at the Sundance Film Festival kind of time period in terms of occupancy. So what I have here is I'm just showing the daily level occupancies for the next 90 days. We have January, kind of that first weekend here. It goes a little further. And we can see where we are this year and where we are, where we finished last year around these dates. And I think, we're really suffering from the fact that the mountains skiing isn't giving us a base level of compression for this event, right? We're really just over halfway there. And so given that it's already the 9th, we're going to have to start relying on this being last minute to kind of make it here. Unfortunately, we apply kind of the basic forecasting based on where we are today, understanding the booking windows may be a little different. This is projecting a little bit of a shortfall. Now, obviously, this could change. The weather could be good. We could see a big influx, and that'll really come in. But it does seem like if we were just looking at how things paced last year versus what's on the books today, we are pacing a little bit behind for these dates. Now, when I take a look at the asking rates for that situation, we do also see that the market at large is generally pushing rates pretty high. And so it does mean that if you're trying to get this booked, you may need to get a little bit more conservative. We do see that in general, rate positions are just solidly higher across this time frame. And we're kind of running out of time, so it's going to be a big guess. I know for a lot of people in Park City, there might be the perspective that like, hey, this is potentially the last year here for a little while, that this is going to be here. We really have to make the most of it. But I don't know how well that translates to the consumer. The consumer can still go to Boulder and go see one, so it's not like the last time they're going to go, and I don't know how much extra of a premium they're going to be willing to pay for that. Then, just to contrast this with the ADRs we're seeing come in across the market, we do see that that's much more conservative, right? So the asking rates are a lot higher than they were year over year. The ADRs are actually very much in line with the year over year. So what is booking is very, very close, especially on the high end. It's a little higher on the median and average to what was happening last year for this time frame. So again, a little bit of that mismatch. The peers in the market, the VRBOs, the hosts, other companies may be pricing a little too high. I know that there is a hope that things will kind of like get better quickly, but I think you got to start planning for being a little bit more conservative. The main reason being we have basically an entire year last year where the trends have been shortfall after shortfall. We see that also replicated in the tax data, which includes hotels. So it's not just our industry. And at the end of the day, I think that banking on being conservative is probably the winning strategy. My hunch is that professionals are in a position to maintain or do better this year, but they're going to do it by stealing market share, by being more conservative and being booked, because there's going to be vacancy. I don't think that people are going to do better just because there's more consumers willing to pay money. And if you bank on that, at the very least, you'll maintain, even if you leave a little money on the table. But the best case scenario is that you really win out, because a lower ADR booking is still going to be worth a lot more than a vacancy. Awesome. Well, I hope you guys really enjoyed this conversation. We'll be continuing this series throughout the year for different markets and different places, and we'll have our recording up on YouTube. Just a reminder, all of the Wheelhouse market data I showed you is available for free in Wheelhouse. We also have a ton of great data that shows your own pacing, which I think is really critical, right? I talked about what's going on in the market, but at the end of the day, you have to compare that to what's going on in your portfolio, because if you're pacing really well, that's completely going to change your behavior compared to if you're pacing behind, right? It's really going to change your risk tolerance idea. And if you need tools that'll show you what your pace is across different groups of units in your portfolio, all the way down to the daily level, Wheelhouse does offer that for free, and we'd love to get you involved and have you sign up and link your account. Anyway, look forward to talking to you soon. Thanks. Bye.